You see a stock suddenly spike. The immediate dilemma is deciding whether you are looking at a genuine surge in momentum or a temporary trap designed to pull you in before the price collapses. Guessing wrong carries a heavy financial consequence. Chasing these sudden fakeouts without verifying the underlying strength is one of the fastest ways traders drain their accounts. To look past the surface of the price candles, we use the Moving Average Convergence Divergence, or MACD. It's a tool designed to visualize the mathematical relationship between different moving averages, revealing whether a trend's internal strength is actually accelerating or beginning to fade. Open your charting platform, like Grow, and pull up any standard daily candlestick chart. Applying the MACD transforms the way you view a chart, moving from reactive guessing toward identifying specific mathematical patterns in momentum. Go to your indicator menu, select MACD, and apply it to your chart. Leave the default settings exactly as they are, 12, 26, and 9. Look below your candlesticks. A completely new panel has appeared at the bottom of your screen. This diagram shows price action on the top half and our isolated MACD panel on the bottom. We will start with the first component, the MACD line, which is usually blue. This is the fast line, making it hyper-reactive to recent short-term price changes. Next is the signal line, usually orange or red. This is the slow line. It acts as a smoother, slower baseline that we use to compare against our fast blue line. Finally, these vertical bars represent the histogram. They measure the exact mathematical distance separating the blue and orange lines at any given moment. They grow taller as the two lines separate and shrink as they converge. The MACD is not predicting the future. It is taking the invisible tension between short-term actions and the longer-term trend and making it visible on your screen. When a stock has been dropping for a period of time, we wait for a specific setup called a bullish crossover to signal a potential buying opportunity. Looking closely at this zoomed-in MACD view, your exact trigger occurs when the fast blue line dips below the zero level and then sharply crosses up and over the slow orange line. To confirm that signal immediately, look at your histogram bars. They must simultaneously flip over the center axis and move into positive territory. Once the price completes its run-up and that momentum is exhausted, you need a defined exit strategy. This brings us to the bearish crossover sell signal. Here, we see the fast blue line peak high above the zero level and then sharply cross down and under the slow orange line. Our bearish confirmation happens right here, as the histogram bars flip back down into negative territory. By requiring these precise visual crossovers before taking action, you force yourself to follow mechanical rules rather than acting on hope. There is a specific market condition where the MACD will fail you, a sideways or choppy market, where the price bounces in a tight range without establishing a clear trend. This diagram shows exactly what that trap looks like. Notice how the blue and orange lines are tangling tightly together along the zero axis, creating tiny, erratic histogram bars. When the lines are braided together like this, the indicator is giving you false signals. Your absolute rule in this scenario is to ignore the crossovers and wait for a clean breakout. Professional trading requires knowing when to execute, but it equally requires knowing when the data dictates sitting on the sidelines. This wide historical view illustrates how these components interact in practice, showing the correlation between MACD crossovers and significant shifts in price over time. You now know how to decipher the mechanics of one of the financial industry's most widely used momentum indicators. Now it's your turn to test it. Open your app right now, pick a stock you track, and hunt down one clean historical MACD crossover on your own.